The monthly close is the discipline that connects every other unit in this module. Cash versus accrual, the chart of accounts, the receipt capture habit, mileage and home office, and categorization. None of it produces a defensible record without the routine that closes the books each month. The next 12 minutes give you the 5 steps, the time budget, and the composite arc of a coach who ran it. Here is the math nobody runs before they skip a close. Skip January, you spend an hour in February reconstructing. Skip January through March, you book a Saturday, half a day to rebuild 3 statements from memory and a credit card export that no longer balances. Skip the whole year and you are not doing your own books anymore. You are paying someone $150 an hour to forensically rebuild what you could have produced in 12 30-minute sessions. The number that should scare you is not the bookkeeper invoice. It is the percentage of coaches who quit reconciling in month 4 and surrender the entire year. 30 minutes is the steady state number, not the day 1 number. Steady state assumes auto-categorization rules have caught up to your spending patterns. Your bank feed is live, and last month closed clean, which means this month starts with 0 carryover. None of that is true the first time. Expect 90 minutes for the first close, 60 for the second, 40 for the third. By month 5 or 6, the routine compresses into the budgeted 30 because the software has learned your vendors and your hand has learned the sequence. Build the routine, then let repetition shorten it. Reconciliation is the one step where the software cannot lie to you. Every other step in the close is judgment. Was this expense ordinary and necessary? Does that revenue belong in the coaching bucket or the speaking bucket? Reconciliation is arithmetic. Either your software balance plus outstanding items equals the statement ending balance, or it does not. When it does not, something is wrong. A duplicate transaction, a missing deposit, a charge categorized to the wrong account. Coaches who skip reconciliation tell me their P&L looks fine. It looks fine because nothing has checked it against reality. An unreconciled set of books is a story you are telling yourself. Deferred categorization is the single largest source of year-end pain. Every uncategorized transaction you leave for next month becomes a transaction you have to research from a 2-month-old memory, a faded receipt, and a vendor name the bank truncated to 12 characters. The cost of categorizing a fresh transaction is 20 seconds. The cost of categorizing a 60-day-old transaction is 2 minutes and a coin flip on whether you get it right. Run the filter, close every line to 0, and write the business purpose note in the same keystroke sequence, not in 2 passes a month apart. The P&L read at close is not analysis. It is a smell test. 3 minutes, 3 reads. If revenue by bucket suddenly shifted, speaking jumped from 20% to 60% of revenue this month. Note the cause. If a single expense category doubled, note why. If net income landed below the tax reserve cushion, you have a transfer to skip this month and a runway conversation to have with yourself. Anomalies get a 1-line note for the CPA conversation, not a deep dive at close. The deep dive happens quarterly, with the CPA in the room after the books have closed clean 3 months in a row. Skipping the reserve check once is how coaches end April $12,000 short. If you transfer per deposit, the close confirms the transfers happened. Open the savings ledger, count the entries, match against the deposits. If you transfer monthly, the close is when the calculation runs and the transfer initiates. There is no third option where you wait until the quarter to catch up. The reserve discipline is enforced by the close, not by intent, because intent collapses the first month revenue is light and the operating account looks thin. Archive is 2 minutes a month for an event you hope never happens. The event is the email from the CPA in March asking what your bookkeeping looked like in July, or the IRS letter requesting substantiation for a 2024 expense in 2027. When that email arrives, you do not want to be rebuilding the statement from a closed bank account or hunting through Gmail for a vendor receipt. You want to open a folder named 2024/07, see one PDF statement and one PDF P&L, and forward both in the next reply. 2 minutes a month, 24 minutes a year. That is the entire archive practice. The routine fails on the discipline of the calendar, not the difficulty of the technique. Coaches who quit the close quit at month 3, not because the steps got harder, but because the calendar block competed with a client session, got moved again, then disappeared. Same date every month, even if the date is inconvenient. Last working day, first Saturday morning, whatever you protect. The routine is what produces the 30-minute number. The routine is also what produces the year-end book that reads as a copy out of the software instead of a 6-week reconstruction. Sam is a composite of 3 real coaches who started closing monthly in their first founding year. Month 1, 45 minutes, because 2 weeks of early receipts had not been captured and the chart of accounts still had 3 duplicate categories. Month 2, 30 minutes. Month 3, 25 minutes, once the auto-categorization rules covered her recurring vendors. By April of the following year, when her CPA logged into file, every month was reconciled, every transaction categorized, and the chart was clean. The CPA email back was 3 sentences. 20 minutes of review, filed Schedule C from the books directly, no bookkeeper engagement. Compare against the coach who handed her CPA 12 unreconciled months and paid $1,800 in cleanup before the return could be filed. Call back to Module 17.9. The same 5 steps appear in Module 17.9 as part of the annual operating cycle. Learn it once here. Run it 12 times a year. 1 unit of training time, 12 months of execution, and a year-end that reads as a copy-paste from books to return instead of a 6-week reconstruction project. The recurring calendar event is the only intervention that matters here. Open the checklist, set the event on the last working day of every month, and block all 12 months ahead. Not 3, not 6, 12. The next close will run long, possibly 2 hours, because no prior close has cleared backlog. Run it anyway. Most coaches who quit monthly closing quit in month 3, after the second close went over budget and the third got moved off the calendar twice. Treat the calendar block as a session with a paying client. That is the only commitment device that survives the 3rd month.